Welcome to YouTube. My name is Lenska with Lenska Realty. I'm a real estate broker and investment specialist, and this is November 2018 edition of the San Diego Real Estate Market Update. I also serve on the board of SDCIA, which is the largest investment club in Southern California. We meet every second Tuesday at 6 p.m. Check out our calendar and speaker schedule on sdcia.com. I'm committed to bring you stats, data, and information that will help to build your fortune, because there is no fortune telling here. And if you like what you hear and would like to maybe hear it again, you can subscribe so you will be notified right away. Let's dive in. Following real estate data points, and we want to find out, is it a seller's market? Did it switch from a seller's market to a buyer's market? Wouldn't that be really helpful to know as an investor or even as a home buyer or seller? Data points: sales and inventory numbers, interest rates, employment data, home purchasing sentiment by Fannie Mae, home builder sentiment, affordability, and notices of defaults or trust deeds. Currently, in October, the median sales price is at $645,000, a 6.3% year-over-year increase. And we can see for the last 2 months it has been going down. And the appreciation is definitely slowing down, as we had like nearly 8 or 9% in the beginning of the year. We have the same story right here in San Diego County with the attached unit in October. The median sales price is $419,000 and only 4.8% year over year. As I might point out, this year the attached units have not been increasing as rapidly as it has been increased in 2017. We only had a little bit of a leveling off in the last 3 months, and this time we really didn't go much from 410 to 419,000 in this year of 2018. We are looking at price per square foot. This is a benchmark figure for real estate, how we value real estate, how appraisers see real estate, how we run comps. We have $403 per square foot, a 7.7% year-over-year increase for the detached units, which has been hovering, kissing that $400 price per square foot line for practically all year. For the attached units, it's just a little bit higher at $423, but we have seen an increase in the first 2 months, and then we have been kind of increasing. Now it has been decreasing, so we see only 5.5% year-over-year increase. Now, when we look at the inventory, these are the active listings in October. It looks like a big number, plus 29%, and we're currently for the detached unit at 5,369. But we came from such a low number of 3,700 that obviously a 29% increase is a pretty significant number, and it also tells us that we are practically, for the first time, the high is higher than the last high, which we haven't seen in about 4 years. Attached units, we even see a higher increase. We see a 38.3%. We currently now have 2,253 listings, but we were practically down to 1,300 listings. Again, the same story here. We have been going lower and lower, and we were wondering, when will the inventory increase? We also add the new builds, the home builders putting more homes online because they're finally finishing those homes, and that contributes to additional units for sale. The market time is about 38 days. We were down at some point about 25, 26 days. So seasonally, we always see an increase in market time in October, November, and December. Now, we can see right here that we're obviously lacking sales. And we're down 16% of last year, even so we have a little bit more inventory, and I believe this is where the market shifts, when you see an increase in inventory, fewer sales, and also we have actually fewer pendings. Now, there are always markets where still the inventory is disappearing, I call it. When you look at Sacramento, Charlotte, Indianapolis, we're talking about a 50% increase year over year, which is pretty strong. Here's some other strong markets in the United States. Seattle, strong job market with lots of tech companies as well. What was the contributing factor for that hot market? We had some really good interest rates. So even so, I put down in 4.87% on a 30-year fixed. I think today I got a notification that we're up to 5%, but still under 4.5 for FHA or VA. If you are a VA buyer, great for you. You can get a really great deal. We have super strong employment. San Diego is in the 3.1% range, where the US hovers around 3.7 for the last month. But if we're looking at the labor participation rate, we still are not there where we should be, because we're like in the 1978 level. And golden years are not so golden. When we look at the labor participation rate growth in by age groups, you can see that obviously the age 75 and over is increasing, because just demographically speaking, it will be there, but also it looks like people are staying longer in the labor force. And Fannie Mae has an index. It's a home purchasing sentiment index. It's a index compiled out of 6 questions. Is it a good time to buy? Is it a good time to sell? It's on everybody's mind. Will home prices go up? Will mortgage rates go up? How confident are you about not losing your job? And do you think you made more money this year or will do next year? Let's see what's happening this month. The HPSI fell 2 points in October to 85.7, which is a pretty low number and down for the last 4 months. And here it is in a little bit more detail. The red circles are practically, is it a good time to buy? We have a decrease of 5%. Also, is it a good time to sell? -3. It is still up year over year, but in October we had a -3 increase. Also, people don't think home prices will go up anymore. Also, more people think that interest rates will increase, and then the confidence about their job also actually down. And this is probably one of the worst report cards I have seen, and since I'm reporting about that index. And my big pet peeve is always the income. We cannot sell higher priced homes if people are not making more money. So what do people think? They think, will their household income be significant higher? No, there is no change. So, and that will prevent people from going out, getting pre-qualified and buying homes. Also builders, even so, more inventory is coming onto the market, but the whole tariff thing and lack of labor and also some slowing in the sales office traffic contributed to a 1% decrease in the West. Overall, it was practically unchanged. We talk about affordability. Affordability in Southern California. Here are some of the salaries in San Diego. You need to make $136,000 in order to qualify for a medium home of $650,000, plus you have to have 20%. So we're talking practically that 1 out of 4 people can afford to buy a house. Oh, didn't I just say buy an affordable house? As you can see, those lines are practically pretty close together. When we had the great low prices in 2008 and the affordability was high, obviously prices shot up like crazy. And remember the last bubble, the housing bubble, 8 million people lost their houses, and we had many trustee sales, which are pretty much non-existent right now. But was it a housing crisis or was it maybe a debt crisis? Obviously, there was too much mortgage debt and people bought houses they couldn't afford. People over leveraged, and we saw housing prices not increase anymore, so they couldn't refinance themselves out of it. So I thought, if it's not a housing crisis, it was a debt crisis, then the question becomes, do you have or not to have debt is the question. Because if I look back through all the recessions of, since only going back about 90 years, because as we know, 90 years ago we had one of the biggest recessions, that was the Great Depression, and some compared our recession in 2007 with the mortgage debt as the biggest recession. But we had other ones in 37, 38. We had lots of government spending and also a recovery hiccup from the recession because it was all debt related. In 60, 61, the Fed raised interest rates, and that was a monetary tightening and didn't help. Then 1969, 70, we had war debt. We had a market crash, which practically was corporate debt in 73 and 75. In the 80s, we had rising interest rates, and we wanted to fight inflation. In the early 1990s, we had too much debt accumulation, and we had the big savings and loan crisis. In the early 2000s, we had the dot-com bubble, which was business that recovered 2007 and 2009. So is there another recession coming? Is it the early 20s maybe? Who knows? What could bring down real estate prices? If everybody asks me what keeps me up at night, probably that is the question, because my clients kind of rely on it and my personal investments as well. So I want to be prepared next time the market goes down. So we always wonder which event, what circumstance, or which person, country, or black swan will end this great cycle. Bruce Norris relies on when affordable hits a low number, but remember last time the affordability was artificially manufactured. Robert Campbell swears by his market timing system, which is great, and I would recommend you guys go to Robert Campbell's market timing seminar. Very helpful, very informative. And John Burns forecast in the cycles according to demographics. I say, let's look back in history to see what the procuring cause was. We said that recessions are part of a business cycle, and it's a nasty habit of recessions to show up when we least expect it. So we always want to know, is there one coming? And as we discovered, that debt is not good. So let's take a look what we have. We have a lot of student debt. We have household debt increasing. We have credit card debt, auto loan debt increasing. Emerging market, no secret about China being in a bubble. So emerging markets have too much debt. We certainly know that the stock market is overvalued. We have corporate debt binging. Debt across the planet is $62.5 trillion. And to make matters worse, the California public pensions are underfunded at historic levels. So, overall said, there is good debt, there is bad debt. Please evaluate your portfolio if it could withstand a recession. If you need help with that, I'm just a call or click away. If you like more education, we have every third Saturday a rehab field trip where we go and evaluate houses investment opportunities as deal or no deal. Or the first Wednesday of every month, we have a real estate profit building 1.0 where we tackle all sorts of various subjects of real estate. You can find all these on the meetup site, and if you like, you can come out and join us. But overall, happy Thanksgiving, and don't forget to set your scales back 10 pounds this week.